Welcome to Market Movers. I'm Jim Urio, and we're back in the middle of Jobs Week. Now, we had the ADP number on Wednesday, and it was a pretty significant beat. Tomorrow, we have the most important data point of the month, and that's the NFP number. Joining me is Chief Investment Officer at Kingswood Asset Management, Scott Martin.
Hi, Jim.
Okay, do you think that the market believes that it's going to be a good number? The last two NFP numbers have been solid beats.
They have, and recent economic data trends would suggest another good number. I believe the market is expecting a good number, but may not want that hot of a number, to be honest, because we still have that kind of fear of what the Fed's going to do by the end of the year, and the fact that recent GDP data suggests that things may be heating up a bit. So a good number, but not a great number, might be exactly what the market wants here.
You mentioned the Fed. Okay, in my opinion, and I want to see if you agree, there's a belief that good numbers are a little more tolerable right now, and we don't have to worry about the Fed, because the Fed might be silly to keep their plans to hike before they see the economic ramifications of the hurricane.
Yeah, I mean, the whites of the economic eyes, so to speak, which is something that Janet Yellen, I believe, deserves some credit for, because they've talked about wanting to see this string of good economic data points before they kick that last interest rate hike in by the end of the year. But let's face it, a good number tomorrow definitely lays that path out a lot clearer.
But that's mostly in labor. There has been some weak numbers in housing and things like that as well. You acknowledge that, correct?
I do, but I also acknowledge that good numbers in the jobs market means more wage inflation, which is something they want to curtail.
Okay, now before we dive into the trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Price and movements are going to vary. When we price these out, the SEP contract was $24.71. Scott.
Yeah, so trading the ES these days has been a lot of fun because there's been some key levels out there. There's been some volatility at times and not some volatility at times. So you really got to get, I think, creative in here and looking at certain levels and prices. We always talk about risk and reward. What's the favorable risk to put on versus the reward? So specifically today, I actually looked at the Wednesday contract on this too, Jim, because we talk about taking some time to let the market digest the non-farm payrolls number, and punched up a 24.50, 24.30 put spread in the ES. It cost you only about 2 ticks, so it's some pretty reasonable protection, I believe. It expires September 6th, as I mentioned, has the underlying at 24.71, so it risks 100 to make a potential 900. Now, if you think about 24.50, there's some moving averages down there. There's a recent breakout from that level. I like the price action down there. If it trades down there in the ES in the next few days, it could definitely go lower. Further downside pressure may allow that put spread to fill out.
Now, I like it. And several times we talk about using the Wednesdays, not the actual Fridays of the number. Because if you use the Fridays of the number and you're not right immediately, the market zaps out all that premium, you lose all your money. At least with these, sometimes if there's a head fake, you get it back. So I like that. I'm looking actually the same expiration date, the Wednesday, week 1, 24.80, 24.90 call spread. Surprise, surprise, I'm going for a call spread, which is 2 ticks. Expires September 6th. Underlying is 24.71. It risks $100 to potentially make 400. Thoughts?
I disagree with it. Still bullish after all these years, to kind of quote Paul Simon there. But here's what I think about it, though, honest to God, is there is a good risk-reward trade in there on both sides. And that's really what you need to think about when volatility tends to come out of the market. Is you don't always need these call spreads or put spreads to fill out. What you need to do is have the ability to work within that range and maybe take it off if you like the move so far, if it even fills out half of it, for example.
Okay. Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.